All right. Welcome back, everyone, to this A-Star Revision Masterclass Explainer on ratios and profitability analysis. I am so incredibly excited to guide you through this today. Think of me as your elite tutor and the screen right here as our digital whiteboard. You know, in the context of IGCSE Accounting 0452, ratios and profitability analysis, it's really not just some boring record-keeping exercise. No way. It is a core architectural requirement if you want to hit that absolute top grade. It's the vital bridge between simple data entry and high-level financial intelligence. So let's dive right in and get you exam ready. To make sure we use our time as efficiently as possible, we're breaking today's masterclass into 4 very focused blocks. Number 1, a concept recap. 2, technical execution. 3, an interactive evaluation. And finally, some critical examiner tips. Let's move straight into Section 1, concept recap. We're looking at fundamentals and vocabulary to lock down the deep conceptual analysis you need for the exam. Okay, so here's a massive trap for the 2026 syllabus: outdated language. Cambridge has transitioned strictly to modern international terminology. That means you must use terms like irrecoverable debts instead of bad debts, and owner's equity with 100% accuracy. Seriously, if you use the old, outdated terms, you are literally throwing away easy marks. Absolute precision is non-negotiable here. And you might be wondering, why does this matter so much? Well, it's because the examiners are testing your readiness for the modern financial workplace. Global accounting standards have evolved, and your vocabulary has to evolve right alongside them to show true mastery of the subject matter. Now, this brilliantly illustrates the absolute foundation of everything we do: assets equal liabilities plus equity. If a question asks you to state the accounting equation after a specific transaction, say buying a new motor vehicle, you've got to remember the duality of every single transaction. You're applying the business entity concept every time your pen hits the paper, and you must maintain this exact equation at all times during the fiscal period. If this equation breaks down, your entire analysis breaks down, and your statement of financial position will fundamentally fail to balance, and nobody wants that. So, the really crucial point here is balancing our principles. There's this constant tension between the historical cost principle and the prudence concept. I see students frequently overstating their profits because they just ignore potential losses. They naturally want to show the business in the best possible light. But let me be perfectly clear, that is a direct violation of the prudence principle. You have to analyze these concepts side by side to ensure total financial transparency. If an asset's value drops below its historical cost, prudence dictates that we absolutely must recognize that loss immediately. Let's rapidly lock in some more of your vocabulary. Terms like accrued, prepaid, realization, and consistency. These are not just flashcard words to blindly memorize. They're the actual foundation of those complex, multi-layered business scenarios you're going to face in Paper 2. For instance, accruals mean matching the expense to the period, regardless of when the cash actually changed hands. And why does this deep level of transparency matter? Because external stakeholders, specifically banks, the owners, and the tax authorities, rely entirely on the integrity of these exact records to make their annual decisions. If your data's flawed, their decisions on loans, investments, or taxation are going to be completely flawed too. All right, that wraps up our concepts. Let's move to Section 2, technical execution. We're going to look at the step-by-step procedural flow. Technical execution requires a really strict methodological approach to minimize errors. You need to trace the exact procedural flow. Let's use an actual IGCSE command word: prepare. Imagine the exam asks you to prepare the books of prime entry for a specific transaction. Let's say a business buys $500 of inventory on credit. What's your very first step? Well, it always begins with identifying the correct business document. Is it an invoice, a credit note, a bank statement? In this case, buying on credit means you're looking for an invoice. Once you identify that source document, it acts as your absolute baseline truth. That invoice then dictates the entry into your books of prime entry, specifically the purchases journal. Only after it is securely in the purchases journal does it flow into your ledger accounts, where you'll credit the supplier's account and debit the purchases account. Skipping any of these steps, or just jumping straight to the ledger, well, that's where careless errors completely destroy an A-star paper. I literally cannot emphasize this next concept enough. Always show your workings. In the IGCSE examination, examiners actually award method marks if they can see your logical flow, even if your final calculated balance is completely wrong. Let's put this into practice. If an examiner says, calculate the revised profit after discovering a fundamental error, showing your workings is your ultimate safety net. Say you miscalculate the final depreciation figure because you hit the wrong button on your calculator under exam pressure. It happens. If you just wrote down the wrong final number, you get a 0. But If you wrote out the correct formula, showed the cost minus residual value divided by useful life, and then made a math error, the examiner will award you method marks. So, do the math out loud on the page. It proves you understand the accounting principles, even if the arithmetic slips up. Now, as you're showing those workings, you'll probably be using the classic T account structure, which is still the absolute gold standard for the double entry system. But watch out for common mathematical pitfalls here. You have to master balancing these accounts by clearly distinguishing between balance brought down, which represents the start of a period, and balance carried down, representing the close. Also, be incredibly careful with miscalculating percentages. For example, if the exam command is to calculate the final amount paid after a 5% trade discount and a 2% cash discount on a $1,000 invoice, you must do this sequentially. First, apply the trade discount, reducing the invoice to $950. Then apply the 2% cash discount on the $950, not the original 1,000. Mixing up that sequence is a trap literally thousands of students fall into every single year. Your goal is 100% accuracy in the trial balance phase so you can seamlessly transition right into the final financial statements. Okay, let's step up the difficulty. Section 3 is our interactive evaluation, focusing on AO3, interpretation, and ratios. This is where we separate the passing grades from the A stars. Calculating a ratio is just a baseline skill. Identifying what that ratio actually means for a business's liquidity or profitability is what defines an elite response. I want you to actively practice this right now. If a past paper asks you to explain why the current ratio of a business has drastically fallen from a healthy 2.5 to 1 down to a highly worrying 1.1 to 1, what do you say? This drop means for every dollar of liability, they barely have $1.10 to cover it. I want you to pause this explainer right now, grab a piece of paper, and write down 3 specific real-world potential causes for this severe drop in liquidity. Go ahead, pause it. Take your time and really think like a financial director. Okay, let's see how you did. Here are the analytical tools and answers you need for these high-level questions. Did the ratio fall because inventory has been massively overpurchased? When a business buys way too much stock, it aggressively ties up its liquid cash in goods that are just sitting in a warehouse, leaving them dangerously short on everyday working capital. Or perhaps trade payables are being settled too slowly, damaging supplier relationships. Or conversely, maybe trade receivables are paying too slowly, meaning expected cash simply isn't arriving. Another massive trap is when cash reserves are entirely depleted due to capital expenditure. Buying a brand new delivery van with cash straight out of the bank account will absolutely crush your current ratio overnight. If you identify these scenarios, you are thinking exactly like an A-star student. You're analyzing the real-world operational causes behind the numbers rather than just reciting a formula from memory. You also need to apply this exact same critical thinking to inter-firm comparisons. You might be asked to compare the profitability ratios of 2 different businesses, but let me tell you, it's rarely straightforward. Different businesses use different internal accounting policies. One firm might use the straight-line method of depreciation, right, keeping their expenses perfectly level year over year. Meanwhile, their direct competitor might use the reducing balance method, front-loading their depreciation expenses and heavily lowering their profit in the early years. These structural differences make a direct apples-to-apples comparison incredibly difficult. You really have to look beyond the surface numbers and ask how those numbers were constructed in the very first place. We are in the home stretch. Section 4, Examiner Tips. We're going to look directly at insights pulled straight from the 2024 and 2025 Principal Examiner reports to secure those final marks. Consider this your ultimate exam survival guide. First, do manage your time based exactly on the weightage of each question part. It sounds simple, I know, but every year students spend 20 solid minutes writing an absolute novel for a tiny 2-mark state question, and then they completely run out of time for the massive 12-mark prepare financial statement question at the end. Budget your minutes per mark. Now for the critical don'ts. According to the principal examiners, students constantly lose points for simply having poor handwriting in ledger accounts. Let me explain exactly how this loses marks. If you write a sloppy B/D for brought down and it looks like a C/D for carried down, the examiner physically cannot award you the mark because the accounting meaning is completely flipped. Clear penmanship is an actual accounting skill. And finally, never fail to clearly distinguish between revenue and capital items. I saw a past paper where a student treated the purchase of a huge new factory machine as a revenue expense rather than capital expenditure. That one single mistake caused a cascading failure. It artificially wiped out their profit for the year on the income statement and grossly undervalued their non-current assets on the statement of financial position. One categorization error ruined 2 entire financial statements. Keep your revenue and capital strictly separated. To wrap up our masterclass explainer today, I want to leave you with this final high-level evaluation thought. As accountants, yes, we deal in numbers. But do your accounting records capture the impact of non-financial factors? Things like staff morale, the physical location of the business, or its overall market reputation? The answer is no, right? They aren't captured anywhere in the ledgers. But these qualitative factors are absolutely vital for a business's long-term sustainability and its true return on capital employed. So as you walk into your exam, always ask yourself, beyond the math, what is the true quality of the profit you are analyzing? Keep that critical mindset, always show your workings, and you will absolutely crush this exam.